Welcome, everybody, to ABG's Capital Goods Sessions. It should be an interesting day ahead. We have 4 presentations coming to you. We'll start with SKF right now, which will be followed by Epiroc, Atlas Copco, and Assa Abloy later in the day. Let's get straight into it. We're very happy to have Rickard Gustafsson, CEO of SKF, with us. He's with us on a link from the headquarters in Gothenburg. Thank you so much for joining us, Rickard.
Well, thank you for having me. Good to be here.
Yeah, let's go right into it. And I thought we'd start with some of the sort of short to medium term issues, just to get that out of the way. I think life hasn't been too easy being an analyst on SKF recently. There's been a lot of, and probably not being a CEO of SKF either, but there's been a lot of moving pieces. And maybe if we just start with one of the defining factors of the second quarter, which was China. Lockdowns in April and May, recovery in June. What has happened since? Are we back to normal now?
No, I can't claim that we have a fully normalized and stable situation. It's still rather volatile. We still see that we have lockdowns in parts of the region, even though it has not impacted the Shanghai area as much this time, but other important parts, and some, as we know, are where others have a lot of automotive production and so forth. So it's still unfortunately volatile in China. We do see some growth areas, especially in light vehicles for us. But on the other hand, the comparison to the same month last year, when I say growth, I compare to the same period last year, the comparison level was rather low. So in general terms, we see volatility, and we're still waiting for wind and aerospace and some other industries to come back that are still rather low. So overall, it's better than Q2, but it's still not kind of a stable, normalized situation in China, no.
Right. And light vehicles were sort of okay in China in the second quarter, but of course impacted by lockdowns, etc.
Right.
But what about sort of, we've heard some signals about particularly electric vehicles doing very well in China and perhaps benefiting from incentives, etc. Is that sort of, is there a big divide there between sort of the ICE and the battery electric that you can see?
Yes, we can. And the growth rates are still significantly higher on the EV side than on the traditional combustion engine side, for sure. That's a clear differentiator. Even though it's a sizable business, it's growing rapidly, but we need to remember that, the base, the size of it, it's still rather moderate compared to traditional vehicles. But we don't see the same volatility or slowdown in growth in terms of EV. That's growing very nicely, and as you probably know, we have a very, very strong position in the EV space across the entire vehicle, actually, which is rather exciting for us.
No, yeah, sure. Maybe to latch on to the second sort of big moving part then, which is sort of more automotive globally, and that was also, very impacted by, all of the disruptions in the supply chain in the second quarter, and you guided for sort of a bit of normalization in the third quarter. Is that what we're seeing?
Yeah, I think that we guided for the group, not for automotive in particular, but for group, we said that we're going to come in at high single-digit organic growth in the third quarter, and one of the drivers behind that number was that we did foresee that automotive would grow rather significantly in Q3. But again, when I say growth, it refers to what the numbers in Q3 last year, and Q3 last year was rather a problematic period for the automotive industry. So the comparison, we need to remember that. But from that point of view, things are developing as expected. We do see a rather strong growth in automotive in this quarter compared to the same quarter last year. and in line with our expectations. So we see no reason to change that outlook of the high single digit for the group in Q3.
Okay, no, that's good. And maybe just while we're on it, I mean, as you mentioned already several times, you have a strong position in EVs. You know, we're talking about ceramic bearings, etc. But maybe you could elaborate a little bit more on sort of which the strong points are. I think you mentioned you have sort of around 1 billion of sales to that segment, but we know you're strong with Tesla. We know you have a strong position with VW in this space. But could this, you know, shift market share significantly as you have that, you know, market share differential?
No, I tend to be rather excited and optimistic in terms of the EV development. The EV industry is growing rapidly, and we are playing a significant role in that transformation and enabling actually that industry to excel and to continue to develop in a positive direction. And why is that? Well, for us, for the electrical vehicles, we have a strong position also in the powertrain, in the electrical powertrain. When it comes to combustion engine, we are not really playing in that space. We're more on the wheel side. But for EVs, we also have a significant part of the powertrains and the motor itself, electrical motor itself. And why is that? For a number of reasons. We have products and capabilities that are really in high demand and necessary to cope with the high voltage that is now becoming a standard in most platforms. And we can then offer higher speed, less friction, and also lower weight, which of course helps in terms of range of the vehicles. And our ceramic bearings, they also solve a lot of issues that are related to lubrication. Of course, this with straight current that also happens when you have high voltages. So I think that our product portfolio and our capabilities are really well positioned to really support the growth in the EV segment. So we're excited about that, and it's a key part of our what we call transformation of our automotive portfolio. If I may broaden the horizon a bit there, we have made a clear strategic direction or strategic choice within automotive that we should play where we have key strength and where we can really differentiate and provide significant value to our customers. And one area is EV, as we just described. Another area is, of course, more heavy vehicles where we have a very, very strong position. We're a clear number one worldwide, and we have capabilities that are in high demand. So we will continue to drive that. Thirdly, we will continue to enhance our position in the global vehicle aftermarket by building out our portfolio, our distribution capacity, and so forth. Today, we're a clear number two, but it's a growing segment and part of the market, and we will be part of that, and also helps mitigate some of the volatility on the OEM side of the business. But then there are other pieces of our portfolio where we are now actively looking into pruning and rethinking. And that's primarily related to, small personal vehicles in combustion engine vehicles where, we can question if we have a real edge there or if we're more a commodity in that space. So we rather refocus our efforts elsewhere. And as you said in Q2, we have identified as of today roughly 1.2 billion of business that we are about to rethink or potentially exit in the automotive space.
Yeah, and the reason that you came to 1.2, I guess, most people think about a bigger number eventually here. Is that sort of what you've identified as being easily separated without too big of a collateral cost, or clearly your ambition levels should be to exit more. Am I right?
That's correct. I'm sure we're gonna find more. But I also need to draw your attention to the fact that this is what we believe that we can, conclude with a rather short time frame. When I say short time frame, maybe within a year or so. We are tied to contracts and so forth, so it takes some time. So this is what we identify for now within a reasonable time frame that we can take action upon. But you're right, we are continuing to dig and we are continuing to work, and there will be other things that probably will also change in our portfolio, but maybe it will take a little longer time.
Right. Just to finish off on sort of the current trading part, in terms of geography, I mean, we hear quite a bit weaker signals on Europe in particular now, while the US has been sort of stubbornly strong, I'd say, from the indicators we can read anyway. What would you say about, you know, do you see big differences there?
No, I think you described rather well. If I go through our geographical footprint at a high level, I would say that we touched about China. China, it's volatile, still growing, but kind of volatile, and maybe in totality, maybe a little slower than we in a normal situation, and volatility, we touched upon that. North America and Latin America, still solid, strong demand, underlying demand enabling us to grow steadily. India and Southeast Asia is really having a good run at the moment with very, very strong demand. So we see good progress there. And then when we come back to EMEA, or primarily Europe within EMEA, you're right. We will, you know, we are driving growth there, but growth is primarily driven through price and mix. It's not underlying volume. Underlying volume is actually starting to slow down.
Yeah, no, that makes sense. Okay, good. We'll just go into the supply chain. Fascinating topic.
Yeah.
And things made worse by the Russia-Ukraine war. Let me start there. I mean, you did have to resource some of the steel that you previously purchased from Russia that cost you a bit in the second quarter. Is that transition done? You know, what will that lead to?
Yeah. The answer is yes. The whole Russian issue in that regard, if you know, from a SKF business point of view, is solved, even though the Russia invasion of Ukraine and the implication of world economy, of course, not yet solved. But from a SKF business perspective, we have exited our business in Russia. We have taken the write down in Q2, so all of that is cleaned out. And to your question about supply chain, yes, we were forced to rethink our steel suppliers, and that has been completed. And we have no longer any dependency or need to source any steel from Russia. It did come with a cost, though. It's a fairly limited amount of our total steel volume that we source. But for this, it costs us roughly 30% on price to do this shift to other European suppliers. Because
and that's a sustainable,
everybody was wanting to
rise,
do it. Yeah, of course. Everybody, had to resource that had a dependence on Russian steel, and of course, demand for other steel suppliers were increasing, and thereby also prices went up.
Now we are starting to see spot prices for steel. Well, actually, have seen for a while. Spot prices are down quite significantly. Transport costs down as well, as far as we can tell. But obviously, in the real world, it's not all about spot prices. So the big question for us is, when will that cost relief start to kick in?
Now, if I start with a general comment, you're right. The spot prices are coming down longer term. That should have a positive impact on our cost structure, naturally. It won't come overnight for us, primarily due to that a big chunk or the majority of steel that we use is actually machine components. So then we have contracts, and so it's going to take us typically 2 to 3 quarters before we do see the change in our P&L. So we have a lag before we see it. But it is also important to mention that, of course, even though spot prices now coming down, and to some extent also the cost for logistics are still at very high level, but though they have been down from the peak levels, but still, exceptionally high. But now we'll start to see, the cost for energy has a big impact, and that's kind of an indirect cost. So of course, even though spot prices on steel comes down, but maybe the machine components that we need to buy will come with a, you know, energy cost on top of that that we also need to manage. So it's not as straightforward as it may sound, but of course, a reduction in spot prices on steel will over time also have a positive impact on SKF.
Yes, and just to challenge, I mean, we have seen spot prices come down already for more than 2 quarters, so you could say that that inflection point might already be here, or you know, but again,
right. But then, as I said, we did not see, you know, the energy prices back then that we see right now. So there are a number of moving targets, but yes, you're right. We'll see some impact of this over time.
Yeah. No, let's do the energy price, because I think you consume about 1,800 gigawatt hours per year, and
correct.
And you have big manufacturing sites in Germany and in Sweden. Correct. So one question is there a lag here as well? Do you have hedges that protects you basically from the biggest rises, or how does it work?
No, but you're right. Let's try to give you a broader perspective on this. You're right. We have roughly 1,800 gigawatts per year, or in kroner, we consume roughly 1.8 billion Swedish krona in energy. It's divided roughly by 1.5 billion for electricity and 300 million for gas. That's kind of roughly. And out of that 1.8 billion Swedish krona, approximately 50% relates to Europe. So around, you know, 900 or thereabout is what we actually consume in Europe in terms of krona for energy. We are not, as you can hear, that dependent on gas. It's a smaller piece of our total cost. And gas is primarily used in Italy and France, not really in Germany. So I think that's also a kind of an important statement. When it comes to if we're hedged or not, no, we're not hedged. Of course, we have contracts over time, so with some payment terms. But I would say that, you know, within a 2 months period, we see the impact on energy prices on our earnings.
Right. Yes. And so, of course, all of this means you're not taking your foot off the pedal in terms of getting price increases through. I mean, is that a fair assumption?
Well, it's absolutely correct. And no, we have to. We have no other choice. We will continue to drive prices to compensate to the extent possible for any inflation. And as I now explained, for a number of quarters in a row, it's been a moving target. It started with, you know, raw material, followed by logistics. Then the energy started to come up, and then we had into total energy crisis. And the next wave is probably, you know, wages and salaries that are on the rise. So there is still a massive mitigation activity to happen, and price will be key there. And we will not take the foot off the accelerator there. We will continue to drive that. But we also recognize that we need to also drive sustainable cost efficiency in our business as well. So we are putting a lot of emphasis on driving productivity and efficiency in our business as well as part of our agenda. And the third lever you have as a business is really to think, you know, can you rethink how you divide your efforts across your portfolio in order to ensure that you probably, you know, focus more on the more high-yielding accounts than low-yielding accounts and so forth. So all of these three levers are something that we work actively with across our business footprint.
Yeah. Is it more difficult, though, when it comes to sort of energy, labor cost compared to steel? Because there's a sort of a tradition, industrial tradition. You know, you've referred to steel prices. You might even have some steel price clauses because it's been such an important part of the cost price, while energy hasn't really been relevant for cost, you know, for a number of years.
No, energy and wages, there are different dynamics to this, and I'm not going to, you know, reveal all our pricing tactics and strategies. But in general terms, I would say that when it comes to energy, I think it's more relevant to talk about surcharges because rather than to bake them into kind of a permanent prices, so that you can actually move more fast, both up and down, if it's more surcharges related. So I think that's part of that equation. And when it comes to wages, in a normal world, we always say that, you know, we believe that wages will increase by somewhere around maybe on average 2%. And that's something that we should, as a company, compensate through productivity and efficiency. But if wages, and we're not there yet, but if some indications indicate that maybe wages will grow by, you know, 7, 8, 9%, then it's going to be hard to compensate fully through, you know, efficiency. So then that needs to be part of the price negotiation as well.
Yeah, no, absolutely. But there's a positive flip side, of course, to the energy price, and that's, of course, that customers now are extremely interested in getting products that save them energy. So just in SKF, it's a little bit harder from the outside to gauge. You know, I can certainly see it in certain areas, like in wind, in, you know, big bearings for, you know, paper mills, that kind of stuff. But, you know, can you give us an idea, you know, how big part of your portfolio you can actually, you know, sell by value-based pricing based on energy savings?
Oh, that's, if I can give you a number on that,
or a few examples anyway.
I'd be more than happy to give you a few examples, because you're absolutely right that, you know, short term, of course, as I described, you know, energy prices will have an impact and we need to manage through, but it will longer term drive significant business opportunities for SKF. The whole energy crisis will, I am absolutely convinced, will put further emphasis on renewable energy sources, where, of course, you know, wind is a natural in that regard, and it will require significant rotation and where we can play. And it's a rather difficult piece of engineering to get a large offshore and or onshore mill, windmill functioning. So definitely, you know, where our engineering capabilities can really play a difference. We talked about electrification before, not just in automotive, but also on the industrial side, where our capabilities really play to our favor to help drive that. Another area is, of course, you know, the need coming back for renewable energies or different energy sources, where hydrogen will probably become, you know, even more important. And in order to manage hydrogen, you probably need to liquefy hydrogen. In order to liquefy hydrogen, you need high compression, and high compression needs, you know, very, very, very high rotation. And there we come in with our magnetic bearings. That is actually the only solution today to solve that problem. So there are a number of cases where, you know, where this really plays to our favor. And I like also to quote our CTO, and Andrew Bell, or our acting CTO, I should say, because soon we're going to have a replacement there. But he has a fantastic piece of statistics that had really stuck in my head when he mentioned it. He said that 20% of the world's entire energy consumption is wasted through friction.
It's been 8 months since you launched the new strategic framework.
Yep.
And there was a number of pieces in that, you know, a bit of decentralization, the exits. What has been done, you know, over these 8 months? You know, what have been the hardest parts and, you know, the big changes that you've implemented so far?
We should remember that SKF is it's a fantastic company with a very, very global footprint and a sizable organization. And like any big organization, it takes some time to change a direction. And SKF is no exception there. But we're all energized. You know, we really now established our new business areas. They are up and running. They are really driving, you know, their strategic direction under our common strategic framework to really make that come alive and deploy it in their respective areas. We see that is starting to make a difference. We really see good development, as we have reported in the last few quarters, on the high growth segments that we identified. We see that we are making progress there. We do see that we are starting to shift more of our customer-focused activities are getting closer to customers. We are engaging in closer to customers in trying to solve their problems. We are more actively looking into managing our or our portfolio in a more effective way. And we talked about automotive before, but the same goes in all parts of our business. And I also think that we start to see that, the different management teams are coming into play. We are seeing that we get more and more business acumen built in our business and so forth. But I need to be humble and say that I do see signs that we are moving in the right direction, but I must be honest and humble and admit that it's going to take us some additional time before this whole thing is fully, embedded and fully running to the extent that we wanted to run. We come from a situation where I had a more functional organization becoming more a business-oriented organization, and you don't change that in half a year. It takes longer, but we are optimistic and we have a lot of internal energy in this transformation.
Yeah. Because do you see the big change in sort of the front end in terms of driving sales? Because correct me if I'm wrong, but you had some divisions already, which were focused on certain customer groups. Now they also have to take a bigger sort of responsibility for the cost end and the manufacturing side, and you have this whole sort of decentralization that way. So I'd imagine that part of it is also, a better understanding of where the cost is and where the margins are, fattest and where you should drive growth. But maybe I've misunderstood things. Maybe this is more of just targeting the right, customers.
No, you're right in a sense. It's about targeting the right customer as well. But to get that clarity and transparency and accountability end to end for the entire value chain creates a different dynamics. And I can't say this is the only reason, but I like to point to one proof point that I think is very interesting. As we presented when presented Q2, we saw that for every quarter we have seen that price plays a bigger role in really compensating us for the cost increase. Now the entire value chain feels the pain the same time. In the previous structure, the manufacturing part of the organization felt the cost, but the sales and the commercial side of the organization were more on a standard cost basis and did not really see and was not fully aware of that. I probably need to compensate on price because my cost will change dramatically. But there was a lag internally before that was tangible and real. So I think that some of that, our ability to really mobilize the organization in this high inflation environment has really benefited from our new structure. So I think that's a one answer. But another one is also clear that, which is not as visible to the outside, but by doing this, we are now also better at assessing in terms of what we say are corporate activities, in terms of IT, in terms of R&D, or in other, key things. We can then clearly say, all of these things that we're now doing, do they truly add value to the business areas? Will the business areas raise their hand and say, yes, we're willing to pay for it or not? That will drive and force us to drive more cost efficiency and productivity internally, which we're also starting to see some traction momentum around. So a lot of things are happening in SKF, even though everything may not be visible to the outside.
Yeah, and one of the pieces, of course, was also that the R&D expenses over time would increase by about 50%, which I think spooked some investors thinking, this might be a big drag on margin in the meantime. But can you talk a little bit about the phasing of that sort of increasing spending?
Yeah, and again, I am a true believer that a company like SKF needs to be in the forefront on R&D. We need to constantly innovate in order to solve customer pain points and stay relevant and thereby provide value to our customers. So we should, and we always must, continue to invest in R&D. And I'm not shying away from increasing that, as I said, in strategic framework. But with that said, though, what we're doing as a first step is really to align the spend that we have today of, just south of 3 billion Swedish krona annually. Do we get the right bang for the buck? Are we really focusing those efforts into those high growth segments that we now have identified? Are those activities that we drive, are they really benefiting our intelligent and clean strategy? And of course, there's some cleanup to do, and I rather make sure that we make sure that we get full leverage and yield of what we invest today, when we're comfortable that we really have more efficiency in our existing spend. Then I'll be willing to also discuss, to further increase it, to accelerate activities further to support our intelligent and clean growth. But we are looking for profitable growth. I like to reinforce that, it's not growth for the sake of growing, it's profitable growth we're after.
Yeah. And of course that target of doubling the business, which is sort of, we know, equates to about 8% per year. Obviously, the cycle can, swing wildly around that and all that. But of course, it is a big step up, from where SKF has been historically. Maybe with just a few words about, the pieces here, because I know you talked about, some of it from market share gains, some of it from new products, a bit from M&A, etc. And I'm sure this discussion will continue, but just to revisit that very ambitious target, please.
Correct. No, I'm glad you bring this up, and some in the audience may have heard this, may say this before, but I will take the opportunity to reinforce my message again. How we ended up with that, because it's important that you differentiate between what we say is our financial target and what is our ambition. We, as I said, when we launched the strategic framework, we're not changing our strategy or our financial targets. I rather want to deliver on those before I change them. That hasn't changed. But however, though, I felt when I came into SKF that this is a company with such a magnificent potential, with enormous capabilities, and a true value add to a number of customers. And we are also really, the key megatrends such as electrification, sustainability, automation, and digitalization is really enlarging the growth opportunities for our customers and for SKF longer term. So we can take advantage of that. But what SKF did not have in the past was the tradition of daring to set some bold objectives. And I want to change that. I wanted the organization to feel that we can have an objective or an ambition to reach much higher than we've done in the past, because the underlying dynamics will support us. If we do things right, we can really, accelerate our growth rates accelerate profitable growth. And we need to dare to set our ambition high. And I can't have that conversation internally in a listed company if I don't dare also talk about it publicly. And that's why it's so important I understand that's a difference between setting an objective for an organization or ambition for an organization and a financial target. We have clear ideas on how we're going to drive this, and we have highlighted that some will come in certain industries, as you described. Some will come from new products. I'm sure M&A will play a part of this agenda, and some we're going to figure out over time how to get there. But the underlying fundamentals in our business model, in our business portfolio, allows us to think big, and we need to dare to have a bigger ambition than what maybe we have expressed in the past. So I hope that gives again some flavor on this. But we are excited about opportunities. It won't be a straight line, because the world around us will not be, just static. We know that we are, experiencing, probably more volatility and uncertainty than at least I can remember in my professional life. Now we tend to forget quickly, but I don't think I ever experienced anything like this with the surroundings that we have right now. But with the 2030 perspective, I'm still, confident that, we will manage through this. There will be opportunities coming our way. And if we play our cards correctly, if we can continue to invest in our customers, in our technology, in our capabilities, we can drive significant profitable growth. because we have something that is actually in high demand among our customers.
Yeah, understood. And it sounds like, the M&A part of the growth story might come a little bit later in the sequence,
Correct.
First get the things in order and then, yeah.
Yeah, absolutely, you're absolutely right, spot on, and that's how we see this. We are constantly looking for things, but right now it's more kind of small bolt-on acquisitions that we've done, like Europa Filter really helped to put some additional value to our Recon Oil offering, so we can then, which led to that we could launch the Recon Oil box, which we're excited about. But it was kind of a small acquisition, and we've done some additionals, one within laser cladding to see how we can experiment in new manufacturing capabilities and remanufacturing capabilities. But the bigger ones, you probably have to wait for another year or two before I think we are ready to do that and have bandwidth and management bandwidth to cope with it.
Yeah. In the meantime, we've seen a few partnerships being announced with, ABB
Correct.
and Amazon. Those are pretty hard to gauge from the outside as well, the importance of those in terms of, tangible business. What can you tell us there?
Well, they don't have a significant impact, that's going to drive growth here and now. But they are strategically important and they are exciting. And we, with the ABB one, we have a partner there that shares our passion about, how do we create fully automated production capabilities. We collaborate on that together today to really drive our automation. So we're going to do that regardless. But if we find smart ways of working and then ways that we may be able to commercialize, why shouldn't we? When two companies have, a similar mindset. So that's kind of what we said there. AWS is somewhat different. We are true believers that this with connected technologies will be important so that we can track the health of our customers' applications. But in order to reach to the lower end of that segment, we need a lower end, sensor technology that is easy to use, easy to implement and get into production. And that's why we initiated this collaboration with AWS to ensure that we also have that in our portfolio. Over time, we're excited about too, but don't expect that to be a game changer short term.
Okay, that's right. Okay. We're starting to come up to time here. Just finally, you just announced the Capital Markets Day here for early December, so we all look forward to that. Any sneak preview you can give us finally here about what we'll hear?
No, we are excited about it. We are a number of things that we like to describe and further drill into more proof points in our strategic framework. Give some more flavor to our growth agenda, give some more flavor to how we see we're going to drive our productivity and efficiency and footprint going forward. So it's more the idea trying to bring our strategic framework more to life with more examples. And we're excited about it. So we look forward to have those conversations in early December.
All right, agreed. Good. Thank you so much, Rickard, for joining us and talking to us. This will finish the first session, and we'll come right back at 10:50 with Epiroc. So thank you, everybody, for joining us as well.
Thank you so much.
Thank you.
Bye-bye.
Welcome back for the second session with Epiroc. We have Helena Hedbom, the CEO, is not well today, but we have an excellent replacement in CFO, Håkan Folin.
Thank you very much.
Welcome, Håkan.
Thank you.
Let's start right away. I think we'll go through sort of the demand, sort of the current demand drivers first, so we have that one sorted. We have had a tremendous market for a long time. Still pretty, optimistic miners out there, but obviously a lot of volatility in overall markets and metal prices now coming down, a bit more forcefully. So what are you seeing? Sort of how is this short-term volatility impacting day-to-day business?
Day-to-day business, I would say, is not impacted. We said after Q2 that we see a high activity level in the market, and we continue to see that. Then, of course, we read the newspaper and watch TV, and we see, the clouds in the sky in terms of, inflation, interest rate, slowdown in the economy. But so far, we still continue to see high demand. And regarding mineral prices, they've come down from where they were maybe they peaked in May or June, but still actually bounced back a little bit in August. So they're still on a high level if we look historically.
Right. It might be that you didn't see sort of the full extent of those very elevated prices.
Exactly.
Anyway. That might be true. But in terms of other indicators, sometimes you talk about exploration activity in terms of exploration equipment sales, that kind of thing. What are you seeing on those indicators?
Also there, we still see high activity level. We see our service business, which also an indicator of the activity levels in the mine, is still performing well. So far, the activity level is still good out there.
Yeah, and in terms of service, you talked previously about maybe a bit of pent-up demand. People were sort of postponing rebuilds, that kind of stuff. Do you think that is now catching up, or are people still just trying to maximize production and sort of maybe pushing some of those bigger rebuilds and services forward?
We talked about in Q1 and Q2. We talked about we thought our customers were buying a bit more spare parts than what they actually maybe needed, since there was or still is a constrained supply chain. We saw it more in Q1, maybe less in Q2. In terms of rebuild, we are actually seeing and have seen this year a quite good demand for rebuild. And what that is that when the machine is getting a bit worn out, we take it to our site and we tear it basically apart and we replace everything that needs to be replaced. We fix the dents, we wash it and we paint it, and then we deliver it, and it looks almost like new, and it gives the miner another 3 years or so on the machine. And that we see actually a very good demand for.
Right, and that's typically a high margin business for you as well, isn't it?
It is a good high margin business. We sometimes get the question, but don't you cannibalize on your equipment sales? Maybe we do a little bit, but on the other hand, we get good margin business for the midlife repair, and also we get the happy customers when we can give them back a machine that will last a few years longer. The customer is happy and more likely choosing our equipment next time they're going to buy.
Okay, good. So maybe we should spend a few minutes on electrification. I know you love to talk about it in terms of customer uptake. It's still a fairly small proportion of your business.
Yes.
So first of all, maybe just if you could give us the framework, of what part of your portfolio this touches, and how big of a business it is today, and then we'll sort of go into sort of the long-term drivers for this.
It is a small portion of our business. We saw Q2 was the best electrification quarter ever. We got some really nice orders, also the first repeat order from someone who has used an electric machine and then bought another one. But it's still a small portion of our total business. It's for the customer, it makes especially sense in underground mines, and there we have said that by 2025 we're going to have our whole fleet available in electrified versions. So we are constantly trying to develop and come with more and more of the machines in electric version, and obviously the bigger the machine, the longer it takes to get it ready. But that's the aim for the underground machine. For the surface machine, we have said 2030, because there we have the even bigger machines like the large pit
and the
vipers.
benefit is not as big, exactly. Obviously.
No.
Because if we talk about that, I mean, the benefit for the customer in terms of lower cost for ventilation, for air conditioning, etc. You would imagine that benefit only increases with the rise of energy prices, yes?
Yes, because to drive the ventilation, you also get very high energy cost for doing that. So I think you're right on that.
Yeah, is that observable, you think, or not really?
No, not really, at least not yet. And I think if you look at the energy prices, it's very much so in Europe. Maybe not so if you travel outside of Europe, and Europe is a relatively small portion of our business.
Yeah, that's a fair point. And then, of course, the whole business model changes, and I think there were quite a few worries about maybe potentially lower sales of spare parts, as you move away from an ICE, and instead you talk about alternative revenue streams. So would you give us a few words on that as well? What would be the big generating pieces here in terms of charging infrastructure, battery as a service, maybe something else that I've missed?
The charging infrastructure that you mentioned, we have actually acquired 2 companies, one in Canada and one in Australia, that can provide this for the mine. I would say that's more for us a way to enable the electrification rather than it's a way for us to get a lot of revenue and profit, because one of the fears from the miners is, well, I'm used to driving my diesel down here, I know how to fuel it up, I'm not sure about this, how to do with the electric machine. And then we can say, well, you know what, we have this company here in Australia, or we have this in Canada, please talk to them and they will help you with that. But then battery as a service, as you mentioned, that's something where we tell our customers when they want to buy a machine that you don't need to own the battery yourself, you can actually buy it as a service from us. And that means we guarantee you that you always have the right battery for your equipment and it's always working. And if there's any problem, we just take care of it. And when the battery gets worn out, we take care of it. And then we can maybe fix the battery, maybe use it for another type of machine, or in worst case then recycle it. And for the customers, I mean, it's still a bit new with this battery and they wonder how long will this last, etc. So that's in the same way as the infrastructure is taking away one hurdle for the, if we can help them with the infrastructure, we're taking away one hurdle. If we can help them with the battery offering and have it as a service, we can take away another hurdle. So, and that can also be a nice revenue stream for us.
Yeah, so maybe it's a bit of an initial, maybe you would expect the take-up of battery as a service to be highest in the early phase of electrification rather than later, yeah?
That might be so, yes. And I think it also varies a bit between the size of the customers, the risk they are willing to take, etc.
Mm-hmm. Right. Are there other hurdles for customers? Because thinking about it, it sounds almost like a no-brainer as you present it to go electric because of the obvious savings, etc.
I think one hurdle is the simple human nature. You've been running your machines with diesel for so long, and here comes some new technique. You haven't really tried it out. You're a bit uncertain. So I think that's definitely a hurdle as well. And also another hurdle is, I already have my diesel machine here. It's only gone for 3 years or 5 years. I'm going to use it another 3, 5, 7 years. I don't need to buy a new machine. What we actually are doing there as well is we're doing what we call retrofit. So if you have a diesel machine, we can actually take it in and we can replace the whole diesel system with an electrified system, and then you can continue running your machine, but actually in an electrified version as well. And that's also becoming very popular to do that.
Okay. Well, if you talk to Sandvik, they'll tell you that they are the technology leader in electrification, and if you talk to Epiroc, they'll tell you that's absolutely not true. And it makes you wonder, maybe you're pretty much head-to-head, but do you think there are clear areas of differentiation in terms of technology between the two, clear leaders in this industry?
We have chosen a bit different path. We have been working together with Northvolt for quite some time and developing the batteries together with them. Like you said, we think that we are the leading one. We also, if we look at new, since it's a fairly small portion, I think both us and Sandvik, we have good overview of what's being sold out there. And our view, at least, is that we are actually leading this race. But Sandvik is of course also there, but we think that we are the leader.
Okay, great. And you'd imagine at least that it becomes even harder for new competitors anyway to catch up. This increases the technology content. Yeah.
And that has been kind of our Epiroc's way of working all the time. That we spend quite a lot of, because I sometimes get the question, well, aren't the Chinese catching up? Aren't you losing market share to them? But we want to continue to develop our machines all the time, and we've had the pit wiper for I don't know how many years, but it's not the same pit wiper we're selling today as we sold 15 years ago, because we charge it with even more technology, more advanced automation, electrification, not for the pit wiper, but for other machines. So you're right in what you're saying, but that's not new for Epiroc. That's kind of what we have done always, to try to really continue to develop the machines. And it's also a way to get more value. If I'm going to sell the same machine to you this year as I did last year, you're not likely going to be willing to pay more for it. But if I can show you the higher productivity, whatever it might be, I might be able to get a few more kronas for each machine.
Yeah. The other driver that you often talk about is automation, and if you would argue against it, you could say, well, automation in mining industry has been going on for 100 years, but from a lower starting point. So is this something that will change growth rates, or is it just sort of a ticket to play that you continue to be at the forefront here? Do you think there's a step change happening in the level of automation, software, etc.?
You're absolutely right in that automation is nothing new for us. We've been working with it for 20, 30 years. It's becoming more and more advanced. I think the drivers are there in terms of productivity, as mentioned before, but not the least safety, that you don't want to have miners out in the worst places of the mine down underground. So I would say it's probably a combination of what you mentioned. Yes, it will be a ticket to play. If we don't develop automation, our competitors do, we will fall behind. But at the same time, it also can definitely help drive growth if our customers see that, well, if I can buy new machines that are automated, I can actually increase productivity with this much. That's of course going to help us sell machines and make them make the switch earlier than they maybe otherwise would have done.
Yeah, and you still
and I'm not sure step change. I'm not since, just like you said, we've been doing this for a long time, and I think the big thing that we are trying to solve, and we have one case where we have actually solved this, is this automation not only for our own fleet, because unfortunately there are not that many mines that only have Epiroc equipment in their mine, but they have other equipment, and they also have normal car vehicles down there. So, but they want to have automation. If they're really going to make use of it, it's the more automation across the different OEMs, the better. So that's something we are working rather hard on trying to solve.
Yeah. No, I get it. And which sort of end markets are driving automation, the most? Can we say that sort of the big miners are really at the forefront here, or can we say that certain metals, is at the forefront?
I haven't heard of certain metals, at least. We have a large project with the large miners. I would say it's the largest miners driving it. It also requires a bit of time investment from their side, and if they can see it work in big scale, that's also where they will have their biggest productivity savings.
Yeah. Okay, let's go into the supply chain a bit, because you have had tremendous order intake and been sort of struggling to keep up in terms of production. I think book-to-bill is running at like 1.4 times for mining equipment. So, well, I guess the first question, any improvement in that supply chain? Have things become any easier at all?
Not so much, unfortunately, I would say. We are still suffering from component shortages, and it varies what component it might be. Maybe where we see some easing is on the semiconductor side. There, I think it's not as squeezed as it was before, but other components are still, there are still shortages, and it can vary, from site to site, and it can also vary from month to month. But But no, not really. No significant improvement in the supply chain, unfortunately.
Right. So should we expect there was only... Well, it was a little bit hard to see in the second quarter because Russia fell off, and we'll come back to that. But it seemed like production rates were pretty steady, you know, from the first quarter, you know. But should we expect you at least to gradually, you know, churn out a bit more products quarter by quarter?
I think that's the right way to describe it. I'm not expecting, you know, a big catch-up effect where all of a sudden, boom, everything flies out. But I would expect a gradual improvement of production output, yes.
And of course, if you're very negative on the economy and metal prices and all of that, you would start to question that backlog, which is now very big, you know. And how can you safeguard that backlog? I think in the financial, sort of in 08, 09, we saw some cancellations. You know, I'm not sure if we've seen much of that, you know, later than that, but yes, with a very negative worldview, you know, how can you make sure, you know, that your order book is firm and real, and there's not perhaps, you know, a bit of air in it in terms of people just ordering too much?
It's a very relevant question, and the longer your order book is, of course, the more important it is to make sure that you have good stuff in it. So what we do is, the most important thing we do is we try to get advance payments. So if you paid, you know, 50 or 20 or 30% advance on your machine, we're not just going to let you cancel it and get your money back easily. So that's number one, and I would say we have been rather successful in getting advance payments. Then what we also do is we call it, you know, audit on our order book fairly regular to make sure that we are not sitting on air in the order book. Having said that, I think, you know, we need to be agile and be ready to act if things will change. If we will have cancellations, maybe not as likely as maybe if we will have not the same growth in order intake on the equipment side. We need to make sure that we are also ready to act if needed.
Yeah. And we mentioned Russia. Maybe it's a good time to go into that because you canceled about 400 million of orders, I believe, in the second quarter. You have about 1.5 billion left. So first of all, what's going to happen with that 1.5 billion?
Yeah, unfortunately, it looks worse and worse for us. I mean, we were kind of hoping there would be some type of a short war or a quick resolution, but I mean, it looks more and more unlikely, and we haven't shipped anything to Russia since 1st of March. I mean, no equipment, no spare parts, no consumables. So you know, the likelihood of us delivering a significant portion of those 1.4 is small. I think we will continue to see cancellations throughout the quarter, and we'll see, you know, what remains of the order book, because right now it just looks like it's going to be very difficult to deliver anything for a foreseeable future.
So then that sort of frees up a bit of capacity, and can you pretty easily sort of convert those orders into deliveries into the other backlog?
One could think so, and me being relatively new in Epiroc, I thought so. But it's not that easy. I mean, for the things that we have not started building, yes, then we can, you know, start building new things earlier than otherwise planned. But we had quite a few actually products where they were almost completed, and especially we produce in US and ship into Russia, and they were almost completed, standing there ready to be shipped, but could not be shipped. And then we need to do some, you know, configuration on them to be able to send them to another market or another customer, because they are basically, you know, individualized, and that's taking a bit longer time than at least I was thought or expecting. So for the one product that we're already kind of in the process, that's a bit more complicated. But of course, for new production, we will definitely do that.
Okay, so supply chain still not really, you know, getting better. Then when you look at Epiroc, you have this model, of course, with a lot of just insourcing of ready-made components, etc. So whenever you look at sort of potential impact from steel price or energy prices, etc., you know, you always score at the bottom of the list because the direct impact is not really there. On the other hand, I guess your sub-suppliers must be pretty squeezed by now. So, you know, are you seeing that cost coming through from that side fully into your cost base? That's question number one, I suppose. And the other question would be, this is difficult for any manufacturer. So how can you support your sub-suppliers? Basically, they must also have a reasonable profitability.
You're absolutely right in terms of the direct impact, and for us, for electricity or energy, it's very small. But just like you say, of course, when we buy a component, our supplier has made it in one way, and in some way they have used energy. So that's kind of pushing up cost. On the other hand, you had steel prices, and we buy quite large portion of components being built in steel. They peaked in Q2 and are now trending downward. So we'll see actually how it develops during the second half of the year. When you add this factor together, what the total situation will look like. I wouldn't say we haven't seen any. Neither, we have seen that we haven't received a good benefit from the lower steel prices, but not really from the higher energy cost either so far. Yeah. In terms of our suppliers, I have not heard at least that we have suppliers that are really suffering at the moment. And with many of our suppliers, since just like you say, we buy quite many components ready-made and then we assemble it. But I haven't heard that we have issues with the suppliers, and with many of them we have very long-term relationships since many years. So from that point of view, I think we will of course try to make sure that we don't squeeze them as much so they will go out of business and then we don't have them when we need them. But I haven't heard that issue as of yet, at least.
All right, because you're also quite concentrated, of course, in terms of production capacity compared to a lot of other companies in Sweden and China, US, basically. India. India, sorry, yes. But then again, your suppliers, I guess, are much more global, and you have a bit of redundancy on most parts. Is that correct?
Yeah, that's correct.
Yeah.
And then it's also something we're working on to source a bit closer to where we actually have our manufacturing. I think that's an area where we have a bit more work to do.
Mm-hmm, mm-hmm. And on that point, for any company, working capital has been on the increase, and people have taken a bit of safety stock, etc. Actually, Epiroc has been at the lower end of that range. You haven't had that much of an increase, so give you credit for that. But do you foresee that you'll still be able to work down a bit on that excess inventory anyway, as things free up in the supply chain, or do you think that you'll structurally just carry a lot more safety stock going forward?
No, I don't think we should have to carry more safety stock going forward. And I think we have built up some inventory, like you mentioned, and I think there should be room. And especially if supply chain normalizes a bit. I mean, we have so much, sea freight are basically twice as long as they used to be. That means we have so much goods in transit from our different factories, both equipment, but maybe even more so on the spare parts and on the tools and attachment. That takes twice as long to get from, our production site in Fagersta, and we're going to ship things to Australia. It just takes twice as long as it normally does. So from that point of view, if and hopefully when supply chain improves a bit, I think definitely we should be able to also lower our inventory level.
I see. Okay. So which cost items should we worry about? Salaries, etc. Is that something that's on your mind a lot? Yeah.
I mean, salaries will go up. I think we've had a long period almost globally with quite limited salary increases, but with the inflation rate, I think we will see higher impact from salary as well. I mean, the thing is, some costs will increase. Hopefully, some will go down. So far this year, we have been able to manage that with working with our customers and actually getting increased prices as well. So we have been able to restore or keep the margin on a good level.
Mm-hmm. Right. Good. So you did an acquisition pretty recently of. It's called AARD. This is an old boat, long year, company, isn't it? It's quite rare to see. This is actually sort of underground machinery. It's kind of rare to see those kind of assets. So, could you tell us a bit more about that acquisition and how you plan to, integrate it into the rest of the operation?
Mm. Yeah, AARD, what they're doing, and it's just like you say. If you look at the acquisitions Epiroc has done, we have not done any equipment acquisitions for a long time, and this was basically a part of our product portfolio that we were lacking. So they make low profile, so they're quite amazing when you look at them. They're so low, so they can travel in underground in tunnels which have very low height. And we have some portion of, or we had before some portion of this, but not really the full production portfolio or product portfolio as ARD has. So now we announced that, and we are hopefully going to close it not too short time frame, and then we will be able then to sell it, especially in Southern Africa. There is a great demand for these type of products there, and our sales team down there is very excited about being able to offer this in combination then with our own products, but also in other areas of the world where this might be where you have the low tunnels, basically, where this equipment is especially efficient, or where our normal equipment can't even go, basically.
Yeah. And the manufacturing footprint, do you think that you could leverage on that for other products, or is it the other way around?
Or both, yeah. No, I've been at their site in South Africa a few weeks ago, so we will see, if there are things we can do down there. If we can produce part of our normal product portfolio down there, or maybe at least you can do some sub-assembly down there, we will look into that.
Apart from that,
so that's I would say that's a benefit that potentially is an upside. That was not the main reason why to acquire it. It was to get the whole product portfolio, so we can really go to our customers and say, you can buy the whole package from us.
I see, yeah. And in terms of the other M&A pipeline, I mean, it's been pretty scattered in a lot of places. It's been sort of exploration, it's been services, it's been software, and I think maybe software is what you'd like to do. Correct me if I'm wrong, but I'm just wondering how that pipeline looks. Are we looking at a lot of technology acquisitions, or rather sort of hardware service kind of add-ons?
Mm-hmm. I think what we might be strange then, since the last one we announced was ARD, but what we are looking the least into is equipment manufacturer. And what we are looking into very much is electrification, and we mentioned a few already during our discussions, automation, and digitalization, and then also into aftermarket. So those are the areas where we are mainly looking for acquisitions. And we announced 8 last year. We have announced 3 so far this year, but we are definitely looking to make more acquisitions.
Has price held you back? I mean, we've seen a few larger mining software deals recently, which you would think, that would fit well into Epiroc, but prices have been pretty elevated too. Do you think that could change, or has that held you back in any way?
Well, I mean, for any acquisition target, obviously, there are 2 factors. One, does it fit into us? And 2, is the price tag the right one? And we are active in many processes, and sometimes, the price goes too high for us, and then we have to look elsewhere, basically.
Yeah. Because some of us, I think, were surprised that there wasn't an extra I mean, this is a board decision, obviously, but Epiroc was spun off, 4 years ago now?
Yep.
With a bit of net debt, not much, but anyway. And since then, basically, it's operated on net cash while still having sort of M&A ambitions. But certainly, the business could take a lot more of leverage if the opportunities were out there. Would you agree, or the other way around? What would happen if you just continue at this pace? With acquisitions, you'll be quite overcapitalized pretty quickly.
You're absolutely right. And I mean, one reason why we have as strong balance sheet as we have right now is in order to be ready if the right acquisition shows up. Then if we continue in this pace where, just like you said, it's been fairly small acquisitions, then we would be a bit overcapitalized. And then especially if we continue to earn money like we have done the last few years. So then we would need to look into ways of reducing our cash position, basically.
Yeah. I guess what I'm trying to ask is, did you have higher ambitions going into this year than maybe has happened? We wanted to be, and we want to be ready to, if the right object at the right price shows up, we want to be ready to strike, and we don't want to say that, no, sorry, we don't have the availability right now. Yeah, and there's been also, again, referring back to Sandvik, they did a fairly unusual acquisition of a company called Desweek, which is active mine planning software, basically. And that's also something that you talked about, mixed fleet automation earlier, etc. So I guess there's a balancing act how far you can go, basically, in tying up your customers before you start to be seen as competing with them, etc. In terms of those kind of adjacencies, is that what you could be looking at as well? This goes a little bit, as far as I can see, beside the traditional mining equipment automation business.
Yeah, no, but it could be, absolutely. And then you're right. You need to make the judgment. How far are we kind of stepping on our customers' toes here? But absolutely, in those, if you call it adjacent, I mean, that to me is digitalization. Then, so that could definitely be an interesting area.
Okay, interesting. So you've been, as you mentioned, you haven't been that long in Epiroc, at least compared to a lot of people in Epiroc. This has been but it's also a company that's very sort of proud about the organization and the culture and how they conduct business, coming from the Atlas legacy. It's just been interesting, you coming from a steel company background to tell us how that differs and what you think the competitive edges are with that kind of model.
I think there are many actually similarities between SSAB and Epiroc. It's classic Swedish industrial company, and as in Epiroc, also in SSAB, a lot of people had been there for a very long time. A difference is Epiroc is actually much more global in the sense SSAB used to sell everywhere, but then we had sales offices and maybe 20 people or so in Korea or wherever it might be. But here, since we have our service technicians all around the world, we have in various countries, like I talked to the general manager in Zambia a few weeks ago, and there are 600 people in Zambia. And we are 400 in Mongolia, 300 in Kazakhstan. So Epiroc is really, truly global in that sense. And then the other thing which I really appreciate is Epiroc has been, from a margin profitability point of view, very successful since the spin-off from Atlas. But still, the attitude is that we can do more. We could sell more here, or we can find more efficiencies here, or if we only do this acquisitions, we can also do this. So I don't at all feel that there's a culture of people leaning back and being happy where we are, but rather the opposite, that everyone is really eager to improve the company even more, which I think is great. And that might come from this decentralization model then you get from Atlas and then now in Epiroc.
Oh, sure, yeah.
But that's definitely a strong, you can feel it, the ambition to be even better.
Okay, good. So good, we're coming up to time. Let me try to summarize, and you correct me if I'm wrong. Demand is pretty good as far as you can see. The supply chain is still pretty slow, but you're sort of continually taking up production. And you're on the lookout for M&A if it comes around, and otherwise we'll get the money back. Is that
I think that's a fair summary.
Fair summary, okay. Thank you very much, Håkan. Okay, and thank you everybody for listening. We'll be back after lunch. At that time, we will talk to Atlas Copco. Bye for now.
Thank you.
Welcome back to ABG's Capital Goods sessions. This is the afternoon session of those sessions. We'll start with Atlas Copco right now, and we'll finish off the day with Assa Abloy after that. I'm very happy to have Daniel Althoff, Head of Investor Relations at Atlas Copco, with me. Welcome, Daniel.
Thank you, Anders. Nice to be here.
Where should we start? Maybe with China. If we go back 3 months heading into the second quarter, we know that you had talked about the distribution center that you operate there being closed for lockdown and all sorts of logistical challenges around that. As it happened, the numbers coming out eventually for Q2 weren't all that bad. So the question is, what happened? Were you able to work around it, or did you have a significant headwind that we now should expect could reverse, into the third quarter?
It's a very good and understandable question, because we also thought the impact might be much bigger. But we were surprised, firstly, how our Chinese organization, but also the market, how quickly they act when things change in a very good way. So actually, we had a very, very strong June that supported. That's one of the factors explaining the results for the quarter. The other part was that our organization, were also able to find sort of new ways, and that not happened overnight. It was a gradual change where we were able to, a larger extent than we expected, find ways of sending equipment directly from our different factories in the different business areas to the end customers, avoiding a route through Shanghai, and that was the area you're referring to that was closed down. So that was the main reason. But I mean, that was for sure the big headwind in China that day. At the same time, I mean, I don't want to initiate any clouds on the sky, but what should be aware, they still have this policy, so it is still, we are aware about the situation as far as I understand. One single outbreak of COVID in a region can then generate similar lockdowns. So let's see what's happening, but so far it looks good.
Right, because there's been some scattered, renewed lockdowns, but not in the areas where Atlas has the heaviest presence. I
think we have had smaller things but not that has affected us on a bigger scale that is material.
So maybe, so you could say maybe, top line wasn't that affected, but efficiency obviously was.
Yeah, but efficiency always becomes a challenge, not only in our factories, you can have it in service, sales people all around. And I mean, those are the parts of the, on top of supply chain constraints. That's another topic that I'm sure we'll discuss. That was the biggest headwinds in Q2, and still is.
And China, of course, is a very important market, not least for compressor technique. And, China, perhaps some hopeful signs in terms of demand, mixed signals anyway. So given that very strong June, is it fair to say that, China has started to come back in a bit more, tangible way for you?
I'm not sure if one should read the ramp up in June as a trend going forward. I would guess it's more a consequence of what they lost in the 2 previous months, and sort of that balance out for the quarter. I maybe even more get the questions from investors. Do you see a slowdown in China? And then we haven't really seen that. If you look at the sort of general industry segments, and I'm then referring to industrial tools, we have the industrial compressors, industrial vacuum, and we were quite happy with the demand and the order intake we got in Q2, and well in par with Q1. And the auto industry also good traction there. There's a lot of things happening there, of course, given the transition to EV cars and new investments. And then, of course, you always have vacuum. You never know intra-quarter what's happening. And you're right, compressor is a very important, China is a very important compressor market, but I would also say for vacuum technique, that's absolutely one of the biggest markets in that business area as well.
Yes. It might be a good idea just staying on with compressors being sort of more of the industrial demand bellwether, if you could say a few words about Europe and Europe and the US as well, the big regions. And maybe also, we saw in Q2 that larger size compressors perhaps outperformed while the smaller size didn't grow that much. What would that tell you,
No, but that's true. If I start with the product group, so basically there are industrial compressors, gas and process compressors, but for the industrial ones, the larger ones, they grow in a faster pace than the others. What does that tell us? I know our previous CEO used to call it the yellow canaries, and they are still singing. But I'm not sure if we, in one quarter, at least we don't make our plans based on that as a true fact. However, I guess in the past you have been able to track that. Maybe is it the beginning of a cycle, etc., but it's nothing we base our decision on. But of course, contributing to the overall demand outlook that we were given in Q2. I mean, in Q2 we had, there were strong performance in all countries, but then of course everyone can read the news today. We also get the question sometimes about increased energy efficiency. Wouldn't that support you now, Atlas, given the high energy prices and so on? And our communication there has been and still is that I think it's, of course, it's better to have a more energy efficient compressor than another one. And it for sure supports the sales process and shorten the payback time for the customer. But we don't expect a hockey stick effect only because of that. There's so many other factors playing in whatever a factory is going to invest in a new compressor at all, if they're going to replace application, etc. So it will not be a single factor.
Put it this way, maybe it could, I guess pricing has been a fairly significant factor for Compressor Technique lately, and partly because raw material prices have been up, etc., and you found all sorts of ways to argue for it. But obviously, again, with the value-based selling, the energy argument becomes more important. So my question is, I guess, given that raw materials are clearly down now, are you perhaps slowing down on the price ambitions, or do you see continued scope to gradually raise prices also in Compressor Technique?
But I think our pricing, you're perfectly right to the value-based, and when we talk pricing in this context, it's like-for-like pricing, right? And then we have been able to compensate, as you said, increased raw material pricing, inflation, etc. But what we call the more structural, we have not been able to compensate for the more what we would suggest is temporary, such as supply chain constraint, COVID, etc. So those numbers are in the books. I mean, inflation continues, right? And when it comes to our raw material pricing, we normally say it's tend to flatten out through the value chain, because even if you see that in statistics, we have contracts with suppliers, right, that they are a bit more long term. So I'm sure our sales organization continue to push pricing. And maybe just to repeat for the audience also, we have been able to do that, as you say, pretty good in Compressor Technique. Actually, in all business areas, we have had a positive price component, even though it has been less so in Vacuum Technique and Industrial Technique, given the key account structure and the way the contracts are set up.
Yeah, the customers have bigger bargaining power, obviously, in vacuum being...
And also more of a long-term contracts.
Yes. Yeah, maybe we should talk a bit more about Vacuum Technique and demand there. I mean, it's... I shouldn't say it's a black box from the outside, because it clearly isn't. We see a lot of drivers there. Still, sort of the quarterly order intake is very hard to second guess, and it's been almost consistently beating on the upside over the past few years. You often talk about large, lumpy orders, etc. Anything we should keep in mind here? I mean, we've been above sort of 11 billion krona per quarter in order intake, much higher than what you've been able to deliver. Is that sort of driven very much by these large key accounts that expand capacity?
I mean, basically, there are only large key accounts. Maybe we have 20 to 30 customers on the customer list, out of which maybe, I don't know, 4, 5, 6 are the really big ones. And when they play orders, these tend to be big orders. And that's why it's even hard for us to predict next quarter, even next month. We don't have the crystal ball there, hence focusing on the agility in the business and the free space of capacity and all of that we try to preach. You're asking me for a number going forward. I think we don't have such a number. internally, we have, of course, plans, long-term 3-year plans, breaking down to yearly targets, etc., that we're not so happy to share. But over time, we are convinced this is definitely a growing business given the increased digitalization, etc., etc. Will we always match the previous quarter? We have been wrong before when we said we're not, but I mean, part of our guidance was, of course, based on what we discussed during Q2 when it comes to vacuum technique and so on. But again, we don't try to have the crystal ball.
Yeah. Now, reading the news about the semiconductor industry, you might get a bit confused because in some buckets, such as memory, you know, you can read about Micron scaling back on CapEx ambitions, but you listen to logic players and they're still very optimistic, and they're sort of driven by, you know, the new technologies and even smaller nodes, etc. So for you, does it matter, you know, which part it grows?
It's a very good question, and I appreciate you ask it, because for us, I mean, we are selling pumps to the fabs and to the process tools manufacturers. And if you look at whatever, on a semi-plant making memory and one making logics, most of the processes are the same. So we're sort of agnostic. Given the key account structures we spoke about before, some of these are more focused on memories and some are more focused on logics. And some quarters, one key account invests, another quarter there's another. So for us, it doesn't really matter. So I think the best proxy for Atlas would be the total semi-capex. So that's where it goes in. I mean, you have seen us writing in our report sometimes it's technology orders or primarily capacity. And that also becomes a bit semantic because if you look, for example, in China, I guess most of what they are doing is new technology for them, but not for others, right? But what we're happy to see, I mean, you see the increased capacity now also driven, I guess, quite a bit from more geopolitical things. But at the same time, it's a technology race out there, right? And what we do know, without being able to quantify, we know that the vacuum intensity goes down when it goes up when it goes down in node. So that's a positive. And every time you make a new technology for the chips, you also normally need new types of pumps, which is very good for us then, if we have the best products. So a long answer to, I mean, so we have seen a lot of capacity coming on board, and we have also invested in our capacity to be where our customers are.
Yeah, and as you say, I mean, it's pretty clear what's happening with sort of some Asian players investing in the US and even vice versa, etc.
Yeah.
There is one area which we cannot really observe that much from the outside, and that is China, as you mentioned. It's not unimportant for you. There are just a few, you know, big players. Is your customer base there more fragmented compared to the rest of the world?
I wouldn't say so if you compare it to the total, and we have been involved in most of the projects you have seen there. And we also have our own production, logistics, we have sales people, we have even some R&D, I think. So I think we're very well positioned there as well.
Yeah, and of course, ongoing discussion about, you know, which technologies should be allowed to be exported to China, etc.
Yeah.
You seem pretty firm on wanting to have a foothold there, and you haven't experienced any basically protectionistic or, you know, trade-related obstacles.
But I think there are two aspects on this. First of all, in this all trade war sort of, it seems like vacuum pumps tends to fall under the radar. But secondly, and even more important, we don't ship any US content. I think there is a rule of 10% of components or whatever. We don't do that. So mainly what's produced in China is also being sold. So that's a strength for us. And the local for local approach is important for us. So we haven't seen that.
Yeah, you know, just looking at sort of growth for vacuum in China, you know, could you provide us with any numbers there? Because again, it's not really caught in the sort of overall statistics sometimes of the semiconductor industry, because most of these companies are unlisted.
To be honest, I don't have that. I don't, on top of my heart, any numbers on that. I can see our growth over the last couple of years in China, which has been very strong. We know what the Chinese government has, at least a couple of years ago, told the market that what they want to achieve. And my guess is when they decide something, they tend to be quite determined. So I think it has been rather strong.
Yeah. Okay, good. Now, before we'll move into the supply chain and all of this, but perhaps a few words about the two smaller business areas as well, industrial technique and power technique. Maybe if you could just share, if there are any, big shifts of trend there.
No, but I think we have, if I start with industrial technique, we have seen we're very happy with the development recently. And of course, extra happy with we also have said that now Israel Vision also contributed quite a bit to the performance in orders and not only in the auto, but also in the more general industry segments. And I also think we are, even though we lost maybe 1 or 2 years in integration due to COVID, we see now projects start coming along where we not only develop Israel on its own and Perceptron, but also the combined offer with the rest of Atlas Copco industrial technique products, and that becomes very strong. I mean, as I mentioned in the beginning, you asked about China, auto, enjoyed a lot of good projects there, and I mean, so from the auto perspective, which slightly north of 50% of industrial technique, we don't see any big change of direction, and we are on a high level, so that is positive. If we look at power technique, I think the biggest new, apart from the strong orders we have had, and we also said that there has been a quite of pre-ordering in there, especially in Q1 from the big rental houses. Not doubling ordering, not fake orders, but pre-ordering, i.e. they placed orders in advance. So let's see how that play out. But maybe the biggest thing there in power technique is also the acquisitions now we have added on with Wangenpumpen and more recently the Leva dosering pumps. So that changed the offer a little bit more towards purely industrial.
Yeah, less construction.
Yeah,
more industrial.
It's not that we want to leave construction. It has been a very, and still is a profitable business contributing to the group's overall performance. But the mix becomes a bit different.
Right. And it's too early to ask, whether sort of, I mean, certainly European construction indicators look, quite bearish, but that might also be a little bit premature to talk about in this.
I mean, there's a lot of news there. I'm not sure if exactly it's a bit premature.
Yeah. Okay, let's go into the supply chain because, we already mentioned the deliveries in all areas, but perhaps most visibly in vacuum have been held back by component shortages.
Yeah.
And so, any improvement basically in the supply of semiconductors, other, we hear that from some companies, some big auto manufacturers, etc.
We can read those news as well. When we ask in our organizations, we haven't seen this light in the tunnel yet. So it hasn't gotten worse. Then I think it's also important to understand it's not only electronic components that has been missing, it's other components as well. But on the electronic components and chips, I wonder if the reason is that we might use different types of chips, or I don't really know. But I think the main message is that we still have those challenges, and if you look in Q1, Q2, that has been the biggest negative factor on the margin, because it's not only that we don't get the components, it's also about that effective efficiency in the factories when you're going to plan the work for the day, etc., etc. And to compensate for this, we of course try to mitigate, because we want to support our customers, and we're willing to take some costs then for example, buying things on the spot market, maybe more air freights, etc., etc. And that has of course diluted the margin, and that we have not been able to compensate for in our pricing.
Yeah, no, it affects in many ways, and some companies talk about workarounds, basically a redesign of products to incorporate simpler chips or more available chips. Anyway. Yeah. Is that a possibility at all?
We definitely work with redesign as well, but it's a time-consuming thing, and it might. And now I'm not only talking about chips. It can be a small screw that you're missing, and also that you need to redesign. But why I'm laughing a bit, I met a guy a couple of weeks ago in industrial technique, and engineer that was just about, and he finished his redesign because we were missing this part. And then when it was done, then the original part was available, but the new one was missing. So it's, yeah.
Right. No, it's a moving target, and we also heard several companies which rerouted transport from boat from China, to rail through Russia, and then that route was closed as well.
Okay.
So on the subject of Russia, you've been pretty, you haven't been too affected, and I guess any further fallout from that we haven't really thought about?
Yeah, I mean, if you think Russia as Russia, we have had very, very little sales in Russia.
Yes.
And that's basically closed now, apart from we do sell service to humanitarian things like very restricted hospitals, but it's a very small part. So I think that is more limited. What is maybe more important is, of course, the whole Russia-Ukraine thing that has an impact on the whole economy. But again, the sales in Ukraine was also not material.
Yeah. And the same goes for energy in total, of course. If you look at Atlas Copco's sort of direct energy consumption, it's very low in relation. But of course, we know that a lot of that comes through in the components and the finished products that you buy. So that's one thing. The other thing, though, is where you do have some integrated manufacturing. It's in Belgium. You mentioned you were in Antwerp yourself the other day. So what are the risks here from potential even gas shortage or very much higher energy prices in certain parts of Europe?
It's a valid question. If I just look at Atlas as a total, energy cost is less than 1% of total revenue, so it's very small in that respect. But I agree with you, the logic that, of course, suppliers down the road, I mean, we outsource 75% of cost of goods sold, and if you take part of that would probably foundries, and of course they're very energy intense and so on, and that might put pressure on them, and then longer term that put pressure on us. So of course that's a bit of a risk. Then I guess your second part of the question was more, I mean, if is basically a stop. And first of all, you mentioned Antwerp, but that's part of the business. We have around 70 factories, let's say, depending on how we calculate around the world, and not exactly even, but quite even split between Americas, Asia, and Europe. And I think this topic is primarily an issue in Europe. Still, I mean, if they're going to cut the cable, so to speak, I mean, jokes aside, but we also have our own generators. And we've actually used that when there was these stops in China, was 1 or 2 years ago, for other reasons. I was there. I mean, we're not that worried that it will be stopped. Will the prices go up? Yes. Will that increase our cost? Yes. But again, on the total, it's rather limited, giving that less than 1%, then everything is not in Europe.
Yes, and the overall health of your sub-suppliers, I mean, is that something that you monitor quite closely? Because again, it might be harder for a small sub-supplier, which is very dependent on deliveries to Atlas Copco, to be able to basically cushion these big swings in cost.
Yeah, I think the whole supply base has been a topic for other reasons the last year, of course. When I speak to the business areas and divisions, I don't get an aggregated picture that we have a problem now. My comment was more, I mean, there might be reason to believe that their costs will go up, and nothing that I have seen yet.
Right. Okay, good. So it sounds like, again, particularly in vacuum, but also in compressors, deliveries are still lagging behind orders, and it sounds like that might continue. But are there other ways to sort of de-bottleneck rather than just component supply, or is that it? We're not talking about labor shortages, just plain capacity shortages that need to be sort of invested out of. How should we think about this?
No, but I think it's not a secret that we strive, for example, then in vacuum technique to have 20 to 30% headroom in semi, given the nature of the business. And we don't have that anymore. We are running sort of flat out, and we continue to invest in new capacity. But even if we wouldn't have any supply chain constraint, we wouldn't, of course, be able to deliver everything we should deliver in time. But in relation to this supply chain situation, and that's of less importance. So it's still the supply chain constraint by far that's the biggest factor. But then one shouldn't forget also, it's not only supply chain. We have had a tremendous order development in vacuum technique, and that explains also the very big book-to-bill.
No, sure, absolutely, yes. And I guess partly related is, like most industrial companies, you've built up a lot of working capital that has consumed, you know, a lot of the cash flow that was otherwise built in.
Yes,
so,
correct.
So that also sounds like it will probably not go away overnight, basically.
No, I don't think it will go away overnight. And part of the inventory we would like to have more, given the situation we are in. But it's also a bit hard to model, to be honest, for the future, because, again, we don't really control where we can get these supply chains. But I mean, it's not that we're not taking actions. We try to work more with double, triple supply, etc., etc. And as I said, then spot market. And the cost also for inventory goes out. FX, but also cost when you buy on the spot market.
Yeah. Good. I think lastly we'll talk a little bit about the M&A. It's been you've been very active. I mean, it's when we sum it up, you're adding something like 4% to sales through deals that you've sort of announced this year. Some of it going into, as you mentioned, also into power technique. Is this something that could continue? We've seen, you know, big pump manufacturers being added, an area which you haven't been very active in historically.
No, but I think I wouldn't like to correct you, but we have been in the pumps business for a while, primarily dewatering pumps in the construction market, adding on Varisco, dewatering pumps into industry, and now Wangen and then Leva. So it's a journey you need to learn, and I think we're on a good track. And I mean, we will continue to develop that business, and as always in Atlas, should you do it organically or should you do M&A? But I think that, of course, there might be opportunities to consolidate that market, absolutely. But here and right now, I think we're quite into the integration of Leva, but absolutely it has where our ambitions are. You mentioned the amount of acquisitions. Yes, I think we have done more than 20 so far this year, which would be more than what I can remember at least. Part of those are, of course, the continued separate track, I would say, in terms of acquiring distributors in compressor technique, which has been very successful for us. That will continue. You also see us doing that a bit in vacuum technique. But apart from that, I mean, there are, of course, areas in every business area where we look into. I would say we have more resources in place in our organizations on the business area level today than 2 years ago, looking into what would be the possibilities. But as always in Atlas Copco, it's about finding the right niches first, and then decide, should we enter this, should we do it organically or through M&A?
Yeah, I know you've been discussing several, you know, potential areas over the past years. We talked about chillers, we talked about low pressure.
Yes.
I think hydrogen has been mentioned a few times, you know, even if it's a very, you know, or rather, you know, what to do in it, what, you know, what's Atlas's part in that value chain. Any of those we should keep an extra eye on, you think?
But I think you mentioned chillers, where I think it's a market where we made an acquisition, but we're also now developing our own portfolio together with that to learn more and to grow that. The low pressure was actually, again, we decided to enter that market because we understand it's a profitable niche to be in. But that we made organically, very successful. So I would say, if not yet, but we're on our way to become market leader, and that's how we do. Yeah, so I think definitely, you mentioned one more.
Hydrogen.
Yeah, hydrogen. Yeah. And of course, hydrogen, exactly as you say, I think no one really knows where the hydrogen value chain, exactly where it's going to end and how big it's going to be. But we're correct, they're definitely working on it already. We do have products. We have a product portfolio that we continue to develop. We're working basically in two divisions in compressor technique. It's industrial compressors and in the gas compressors. It's primarily pistons, but we're looking into other areas. And how we're going to continue to develop this is, of course, the same approach. We can do it organically, but opportunities for M&A is also an option, definitely. But it's really much my understanding is it's a market that no one really knows exactly how that value chain is going to be. But what we do know, or at least what we truly believe in, producing hydrogen, distributing hydrogen, there will be need for compress and expand and also dry. And these three things I think we're rather good at. So absolutely opportunities, but it's very hard to say where it's going to end and exactly where we're going to be. And that's exactly where we are now, looking at where should we be.
Yeah. One area of the market that we get some questions about now is sort of the whole oil and gas value chain, because obviously that one has been around, and I often get the question, you know, which parts of Atlas compressors actually serve that market, because, well, actually that's now one of a few end markets that's growing.
Yeah.
What a change from, you know, 5 years ago.
Yeah.
So why don't you do me and the listeners a service and sort things out, you know?
Yeah. And then you need to divide oil and gas, what do you mean with gas? But if you look at oil, I mean, crude oil, that's absolutely a smaller part of what we do. And we are now talking about compressor technique, of course. And we are primarily we are in midstream and downstream. But that's a very, very small part of total compressor technique. And it's primarily in gas and process division. But even in that historically was very exposed to that and steel production, I think, was the big thing. But here you see we have broadened the scope that substantially and much more into LNG, hydrogen, as I mentioned, a wide range of applications. I'm not sure here if you say LNG, is that gas? Yeah, then the oil and gas is quite big. But here we have seen very good development. So, of course, if the oil part is growing, and we are there, as I said, but a smaller part.
Yes, and certainly certain categories you're not very, you know, into, of course, in terms of certain very high pressure compressors, etc. And I guess that's the way it will stay, or you think?
I think we don't close any doors, but I think to put all eggs on looking at oil, I think that's not what we're going to do. But it's more around the gases, but then, of course, there will be a need for oil also in the future.
Yeah. Okay. Good. Good. So a lot of open doors.
Yeah.
I think.
hope we can close them.
Yeah. Well. Yeah. Good. So it sounds like. Let me try to summarize. It sounds like still component shortages out there, holding deliveries back.
Yes.
China, you maneuvered well in terms of difficulties in the second quarter, and so far so good in terms of the situation in the third quarter in terms of COVID, at least.
Yes.
China, is that how we should read it?
I think it's a fair description.
Yeah. Okay. That sounds good.
Very good.
Thank you very much for coming here, Daniel.
Thank you, Anders.
Thank you. And that's it for the Atlas presentation. We'll be back shortly with Assa Abloy. Bye for now. Welcome back. This is the final session of the day of these ABG's Capital Goods sessions. And last but certainly not least, we have Assa Abloy here, represented by CFO Erik Pieder. Thank you very much for coming.
Thank you for having me.
Should we dive right into it? Maybe I think the worry on people's mind is probably the construction cycle in general and housing start. So maybe sort of just with the backdrop of what happened last quarter and how you see the world, maybe we should just do a little sweep, across the major regions in North America and Europe and, well, particularly those two.
Yeah, if you look, the starting point, if we start from the West, I would say that Americas, US, still fired on all cylinders. We see good traction in both residential and in the commercial. And if we follow the ABI, it's still above the 50. And we also see very high activity levels on specifications. I will then, because the most interesting one, I think, is Europe. So that's why I will move first to the East and then come back to Europe. I think by the way, also South America, there we also see it's been strong for quite some time and it will continue to be strong. If we then go to the East, I would say Pacific, there of course now it's a little bit different with the comparable numbers because they had lockdowns like in New Zealand last year, but still we see a pretty good activity level there. Southeast Asia coming back a bit. China still very depressed, and for us it's two things. One is the COVID pandemic, and then the second thing is also the crisis that you have with the real estate developers. So I am not very positive about China for the period to come. India, good progress. We also see Middle East and Africa coming back. And then the big question mark is Europe, where what we see still we have, because we see the inflation, we see the energy. In the markets, I would still say that the northern part, Finland and Scan, there we still see good momentum. But then if you go to Central Europe, if you look on UK, if you look on the Benelux, to some extent, France, I would also say there we start to see, let's say, it starts to get tougher. Mm-hmm. Southern Europe, it's, I would still say we don't really see the impact yet. But coming back to what, the interesting, I would say, I think we have all the signs are in, I think, for that Europe will have a very tough last part of the year and then going into next year, with especially then if you take the, let's say, how the gas line goes with East Europe, but also Germany and also going into France.
Yeah. And can you see a difference between residential and commercial in Europe, or is that too hard?
I would say that we would see it more on the residential side than what we see it on the commercial side.
Yeah, no, that makes sense.
Yeah, so, and of course now with inflation being at the level that it's at, people are getting warned about that you need to save money in order then for the energy bill that will hit you quite tough in December, January and so forth, and then interest rates are going up. And that of course means that certain, I would say, if there are things that, perhaps you don't need to upgrade your locks right now because, you need the money for something else.
Yeah.
And that's sort of what we see. And then I think for us also going forward, and I read this morning that it looks better in Germany than if you would have asked a month ago when this, let's say, with the gas supply for the winter. Because for us it's also important with how we can manufacture during, let's say, during the winter. Yeah. Okay, we are mostly assemblies, so it's, let's say, not such a big, it's not so energy heavy, but of course it will have an impact for us if we, let's say, in East Europe, if we take that instead of as an example, if we can only run the factory instead of running 7/24, that we instead only can run 3 and 8.
Yes, yes, and obviously you have large manufacturing in the Czech Republic,
Yeah.
for instance.
Yeah.
Is that what you're thinking mostly
Yeah,
about?
that's what
here?
I'm thinking about. We have it in Czech, we have in Poland, we have in Bulgaria, Romania, and then, of course, a bit also in Germany.
Yes, right. And just circling back to the US, I think people worry about the sort of, you look at housing starts, etc. Obviously, what you have in your opening solutions, yet anyway, in North America is not so tilted towards residential.
No, we are stronger in commercial than what we are in residential. But we don't see, there I would still say that the pattern that we see in Europe, we don't really see in the US. And it's also they're coming to the winter. I mean, they are self-sufficient when it comes to energy. It's also so that, I mean, I was in the US last week and we met two of our customers, and they were sort of not so, let's say, they were sort of not so negative, I would say, for the future outlook there. So, and perhaps there will be a mild recession in the US, but so far we don't see any signs of it.
Yeah, and you mentioned Latin America. It's I think when most of us from the outside look at sort of your Americas business, we have so much data coming out of the US, right? But
yeah.
but Latin America is a bit of a black box for us. So maybe a good opportunity just to describe, you know, what you have in that region and how it's growing, you know, and because it's not that big, but it's, as you say, it's contributed in a fairly big way.
Yeah, it has been growing, I would say, in the last 2 to 2.5 years. It's predominantly residential. I would say the engine, and I would actually sort of say that we have actually done a turnaround in Brazil, where despite that, if you look on the macroeconomics, you would say that, you know, Brazil would not be the macroeconomics, the political climate and so forth. But despite this, we have been able to move our positions forward. We are increasing in that market. Of course, it's driven by, as I said, it's residentials. It's driven. We have done a couple of acquisitions there, Udinese, Papais, who have a very strong market position, and that's something that we are benefiting from. But we also see other parts, Colombia doing well, Mexico doing well, Chile still doing well, but there it's a bit of political turmoil. I think now at least they stopped the referendum, but there is some turmoil in there. And also I would say a very small market like Peru. But in general, it's I think it's for us, it's been a solid performance. We have good management teams there, and they have been able to drive, let's say, continuous growth despite the very tough economic climate.
And sort of the opposite of that is China, which is now only like 4% of sales for you. And I think for some time we've thought, well, it couldn't make much of an impact then. But actually the negative growth numbers have still been big enough to make an impact on the entire group numbers. So, you know, when are we at the point where it's really can't make a dent anymore? I mean, it's very small, but we're also talking big negative numbers.
Yeah, you're right. It's as you said, it's contributing less and less to our top line. That's for sure. And in the past we said that no matter what happens with the economic climate in China, we still would have enough space to grow. But I think with these two big things now that you have with COVID, where, you know, with the lockdowns that they're having, as well as this with the very tough conditions that you have for the real estate developers, that has sort of impacted us. Even though you can't see it, we have talked before that we have put the plan together. Let's say what we want to do, like for instance, growing more in commercial, consolidating on fewer brands. Even though it's difficult for you to see, we actually see that we're making progress there. So those are actually, but in the scheme of things, you know, it gets lost. But
But you're committed to sort of investing your way out of, you know,
yes,
to better profitability in China
yes,
rather
yes.
than, you know, exiting.
Yeah, no, and still remember that before, let's say, this last crisis, we were profitable. We were mid-single-digit profitable in China, and that's something that we should be able to come back. And in long term, of course, having the double-digit profitability. The second thing is also that it's important for us because technology-wise, a lot of the times the Chinese are in the forefront, and that technology will then spread to other parts of the world. So is also another reason why it's important to be in the Chinese market. And the third is also that we still produce ourselves, but we still produce ourselves, and then which is then sub-supplier to other divisions. And there it's also important not only to sort of manufacture, but also being able to sell on the Chinese markets. I would say those would be the three. But I get that question from time to time. Isn't it time to exit China? But we're not going to do it.
Okay, that's clear enough. There's been some discussions as well about sort of the still sort of the return to normality sort of post-pandemic in the hospitality sector, in parts of access control, and intuitively you would think we're already there, you know, occupancy rates are pretty high, etc. But what's the status?
If we start with the hospitality, exactly what you see, we also see, and you've seen it in a couple of quarters, at least in 2 quarters, that hospitality is starting to move upwards. And I think what we may predominantly see there, I would say, is the aftermarket piece. I think if it will continue the way that it has now started to move back, I think then we will also start to see the investments, because right now it's also that the hotels, they are, let's say, getting their nose above the water, and they want, let's say, to at least sort of be halfway up through the water before they think about, let's say, doing large investments or opening new hotels. But if it continues like this, then that will come. So I think it's more, as I said, we see that the momentum is coming back in the hotel as well as in the marine. I think if you could then take the access control, which would be more, let's say, the packs, there the demand is back, and that's actually at a high level. There we have, of course, been very much impacted by the electronic component shortages. And that's I mean, we have talked about this around 300-400 million SEK per quarter, and let's say out of the 403 million have been packs. So as we now start to see signs of improvement within the supply then for electronic components, then we also start to see that the top line is also coming back.
Right.
As said, I think I would say that I'm more positive now than if you would have talked to me 9 months ago or a year ago about this than I was at that time.
Right. Yeah, at least looking at sort of the main competitors' data, it does seem anyway like you've delivered a bit more than, so it doesn't seem like you're the only ones who have been having problems with the supply of electronics.
No, I think it's not only our industry, it's also other industries. And of course, when we hear and see that the automotive is starting to see clear improvements, you know, they are on top of the let's say of the value, and we are coming a little bit lower. So we see signs also for us that it starts to improve.
Right. So a bit of catch up of that backlog, which from the outside we haven't been able to see really. But you talked about a few 100 million of lost sales, and that's packs in Global Technologies. That's basically it, right? I mean,
that's the main part of it. Yes. Okay, could be a bit on the other one, but that would be the bulk part of this 300 million would be packs.
Okay, good. No, that's a good leeway into the whole sort of supply chain situation, because this has been very tangible there. And there's also been cost increases, obviously, of the important raw materials for you. So, you know, steel, brass, all of that. Looking at spot prices, it's quite easy to get hopeful, but timing-wise, how should we think about it? Have you already sort of borne the worst, basically, in terms of the price peaks that we saw in the beginning of the year in terms of steel in particular?
You have the two mechanisms there. I think if you look on steel, I mean, it has peaked. It's now, which I think is good for us, it's gradually going down, which means that we have, let's say, a higher success of maintaining a higher price level for this specific ones, the steel doors and the perimeter security, as ever goes straight down. I mean, it takes us roughly, let's say, 6 months before, I mean, what we purchase until that sort of it results in a sales. Yeah. The other thing, I mean, that's a rule of thumb. But then on top of that, you should also remember that inventory has also, because we have been needing to secure supply, which means that it might be a little bit longer because let's say that we're eating off our inventory. So I think I think that is sort of that sort of we see that, and of course they're coming back the availability. Today it's the one I would say it's two things today where it's, let's say, scarce resource. One would be still for us the electronic components, and the second one is labor. It's still sort of it's difficult to find people, but then if you go, like you said, with the steel, with the brass, with the nickel, with the aluminum, it's there. So we are able to sort of secure supply.
Yeah, so for steel, maybe we should think about sort of the new purchases coming in for you are at lower prices now, but then we have to model the material throughput time basically to see when it hits the P&L.
And normally, as I said, 6 months, be model a little bit longer due to let's say our inventory reduction.
All right, and you've raised prices, say 7-8% accumulated, basically since this inflation started. Do you think that will go on still? You know, you'll still do a few percent more, given what you've seen in the past quarter and given what you've announced, etc. Or is that it? Do you think prices will plateau here?
I think we need to separate a bit. I think for the bulk part, it's still so that we will still continue to increase prices because steel is, let's say, the raw material is a smaller piece, and it's also the cost per piece is actually lower. So, I mean, there we'll continue to increase prices because, I mean, if you look now on the inflation numbers that are coming out, still you have this with electronic components, which the price are high. So there we are continuously, and we will continue to raise prices. So, I think price is still, it's a continuous evolution. And there's always things you can do on pricing. The one where we might sort of see is those where, I mean, in the door business in the US, where you have 70% is steel, or when you take the perimeter security, where it's steel fences, and you sell normally to, let's say, larger projects. There, it will be much more difficult to, let's say, to continue to increase. There, I think it's more of a maintaining kind of strategy that we need to have.
Mm-hmm. And you think that's possible?
I believe that the way that it's now, let's say, slowly going downwards, I think there we have a better chance. So, yes.
Right. If prices come down very quickly, it might
if prices come down as they went up, then it's much more difficult. And I think it's also something that we have learned, and that is something that we saw already. I would say that you need to be very fast in order then to implement the prices. And then it's also now, right now, it's easier then also to maintain the price increases that you have done if you were earlier. Instead of, you're coming, if you today come and say, but I need to have price increases for steel that I bought 6 months ago, the customer is just going to say, but we live in today, not 6 months ago.
No, of course. And you mentioned labor, okay, so that's for everybody to think about, sort of a higher, wage.
And it will be higher. It will be higher salary.
What are we talking about, you think?
I mean, traditionally we have been, let's say, 2.5, something like that. I would be somewhere north of 4.
Yeah.
Of course, the difficulty here is also when you model for next year is that some markets, like for instance the US, there, let's say the market is much faster, which means that some are already in. Whereas then if you look in Europe, there it's more, if I call it, it's more, let's say, based on negotiations and so forth like that. And I mean, that's also going to be an interesting thing to see what's going to come out of the labor negotiations then beginning of next year. If it's sort of the scenario that I paint that we might be into, let's say, a recession in Europe, but then you have had the inflation, you have the energy prices, what is going to happen in those negotiations? Yeah. But I gave a long answer to your short question. Think north of 4.
Okay, and then sort of everybody's talking about energy, obviously, and it's a pretty small part for you directly, then it might still indirectly affect, etc. But even a small part can matter if the price increase is, 3x, 4x.
Yeah, but we see it. But in today, energy is roughly 80 base points of our sales. And out of that 80 base points, I would say that half of it would come from North America, from US. There I would say our main energy consumer is perimeter security. But you're absolutely right, that is for us. But then you have the second thing is also coming from a sub-supplier. Still, I think the main risk and is, of course, when looking into will we have power shortage, will we have, let's say, power stoppage. But we already see what you see in Europe with, let's say, with the X factor on the energy prices. It's already there.
Okay, I see. Good. All right. No, okay, so if we sum, you're about 15% margins for the group now. The big moving piece here will still be the trade-off between your price realization and steel cost if we are going to simplify. Would you agree?
I think you need you need to take more than steel cost in. Okay. You need to take, I would say, materials in total. The steel, of course, the steel, and the brass, the nickel, but also the electronic part into that as well. And that's why we have shifted a bit in our communication. Before we talked about raw mat, but now we've also started to talk about, let's say, our full direct material, which also includes electronic components. Yeah.
No, sorry to dwell on this, but okay, so you sort of lacked some electronic components which have sort of held back deliveries. But has it also been that you paid sort of outrageous prices sometimes for electronics that has impacted cost,
yes.
Just to get the availability?
Yes.
Okay.
Yes.
So that is also something that can normalize, yes?
Yeah.
Good. All right. Great. Okay, your favorite subject, I'm sure now, the pending acquisition of HHI.
Yes.
So it's been a year.
Yeah.
And, what can you say? How hopeful should we be that, they'll finally get some kind of decision out on this?
I think it's just going to take a while. And that's what you saw, that we have now sort of stopped. We have agreed with the seller then to prolong, let's say, the magic date of 8th of December now until mid next year. And both us as well as Spectrum brand are convinced that at the end of the day we're going to get the deal through. It's just going to take more time. Mm-hmm. There is sort of the antitrust authorities, they're having concerns and so forth like that. And then, we have to see. But at the end of the day, we're convinced that we're going to get it through. But my estimate is that you can continue to ask me about this, I think, until end Q1. I think that sort of would be more of a realistic time frame.
I see. Okay. Yes. Are you concerned that sort of the quality of the asset deteriorates a bit while it just sits there a little bit in a limbo, between the seller and the buyer, in terms of making the seller making new investments into it, that kind of?
There's always a risk that, let's say, that you have this when you have a company which are, as you said, in a limbo. I mean, the previous because since we've had a previous experience, but that was with Brussels, where the record acquisition took 18 months. In that specific case, we could see that that they were doing business as usual. They were continuing the same, let's say, in the same pace. In that acquisition, as well as in this acquisition, the management team, they will remain, and they are really looking forward to joining the Assa Abloy group.
Yes, I think it might not have been that case really. The seller was not so cooperative in the Acta deal.
No. Let's say they weren't that cooperative. Let's say that it was quite a long time.
Yeah.
I mean, actually from the first, when let's say the first stake in Acta Record was bought, the 39%, and then it took a while. Yeah. In this case, it's also so, as I said, that the management team here will stay, and it's also so that HHI, they have been acquired. We are the fourth one who have acquired them with the same management team. So in a way, the management team, they know the drill. And they also, since they are committing and staying, they also know that, let's say, what they haven't done, if there's some things which they haven't done, let's say, in this period, then, of course, in a way, because they need to clean up their own mess. And I'm sure, you know, that they want to, let's say, continue and, of, let's say, being a successful company, as well as, I mean, they are really looking forward to, let's say, having a long-term home. And they know that if Assa, we're not so known of, let's say, buying and selling, and this asset, they know that they're in, you know, we will continue to have HHI as a part of the Assa Abloy family for quite some time.
Yeah. And it doesn't really seem like this whole sort of pending deal has held you back in a big way in terms of making other deals. I mean, I think I made the calculation that you've added, you know, almost 4% to sales through other deals since HHI was announced.
Yeah.
So, because intuitively you'd imagine that there's a bit of an execution scarcity, you know, just and balance sheet wise as well. So, as a CFO, you know, how do you see that balance sheet room? You know, allowing room for this deal to be made, which incidentally, of course, with the dollar has become more expensive too.
Sure. No, it has become more expensive. When we did the calculation from, let's say, when we started to look at this, when we did the calculation, and it still is valid, is that today we are, let's say, net debt to EBITDA, let's say around 1.4, 1.5-ish, and we would go, let's say, up to around 3. And still 3, we would, even with that, we would still have, let's say, room to maneuver to do this kind of acquisitions that we now have done. And I think that is also so one good thing that it takes longer is that then we also have a chance to generate more cash. And that cash is also something that we can utilize for this, and that's what we're doing. So already when we did it, and it's the same now, that even, or let's say despite that we would acquire HHI, we still would have enough firepower in our balance sheet to continue to do the acquisitions that we have been doing. I mean, this is a part of our DNA, and we will continue with it.
Yeah. And that is one other sort of fairly big question. I mean, it's if we look at the past, you did a number of deals in mechanical locks. You did a number of deals in some access control technology, and then you did the whole build-up of the entrance systems division. And so when we think about the next 5, 6, 7 years, which vertical do you think you have room to sort of continue to drive 4 or 5% acquisitive growth in?
I think you have it in a number of different areas. I think it's also so that the way that we are structured, because that was a question that you had, how is it with management capacity? And in a way, HHI, that is Americas. In a way, you can say Americas, they haven't done that much acquisitions over them, but it doesn't sort of impact the other ones. I still think that within entrance, there is still a lot of opportunities. Like both with products and regions. We also have, what you have seen is that we have done quite a few distributor acquisitions, which in a way means that there we can also sort of get closer to the end customer, and we also get the aftermarket and the service. So for sure we have possibilities there. You have also within the global technologies is also space, and we have started a bit to roll up an RFID. You've seen a number of RFID acquisitions. There's also other things that we can do, let's say, within the technology spectrum there. You've seen a bit of, I wouldn't call it adjacent, but like Caldwell, a little bit like Aranile, which is window hardware, but there is a clear synergy between. And I think those are areas that we still can do. Then, I mean, you also have some of the emerging markets, like you've seen we have done in Brazil. And we also have possibilities there to do more. So it's not so that it's within one. I think we have a number of different areas, products, aftermarket, and regions where we still have the possibility then to continue to do acquisitions in order then to fulfill the 4 to 5% target that we're having.
Yeah, and technology in terms of sort of, should we say, defensive technology, you know, just to keep up with technology trends, because inevitably, you know, we're going from more mechanical locks and cylinders and master key systems, which might, you know, could be very profitable,
yeah,
into more, you know, contactless, more biometric even, perhaps, which
yeah,
is not, you know, where you're not very strong today, you know. Is that something you...
That's also possibilities, exactly what you're saying, is that going more into the spaces of access control, electromechanic, those are areas. Biometrics, I would say that there we also need, you know, you can call it even a defense approach, that we need to cover more technologies than what we do today, because today I think we're very strong in fingerprint. But we can also see, like we did, was it last year, we bought a stake in Paravision, which is more, that's more algorithms when it comes to facial recognition. So that's also a possibility. And then I think the future there is going to be more a combination of the things, and there I think we're going to try to position ourselves in the future.
So it doesn't sound like you think you need to open up a completely new sort of vertical. I mean, no. Which in a sense, you know, you could say Entrance Systems was when it, you know, was open, but there's plenty to do basically in each that there is.
Yeah, no, there is.
Okay, yeah, okay. No, we'll just have to wait to see when they...
We have to see. I mean, and as you've seen, we have done quite a few, and I would say that there is a lot in the pipeline, and there's quite a lot of activities right now in M&A, which I think is good.
Okay, so we're starting to come up to time. We'll just, you know, circle back. So it sounds like, you know, the US is still very confident. The Europe more of a question mark. The question is, looking at the past in Europe in these kind of new construction downturns, I mean, it's typically been balanced or even offset, you know, by renovation markets, all of that, you know. Do you think that resilience that has been there historically, I mean, is there any reason why that wouldn't work out that time? Is this...
No, I think it's...
Is this a different cycle?
As long as we don't get, let's say, a new lockdown, because the lockdown was in a way that hurt us. Because as soon as people can move around, as long as people are allowed to do renovations, then I think our resilience model would work. And I think it's also what traditionally happens when it goes down is also then we start to see more, I would say, government projects of renovations of airports and so forth like that. And that is also something that's helping us from a resilience point of view.
Great, sounds good. I think that's pretty much it. Anything you think we should add to this?
No, as always, you know, I think you know the company quite well, so we have sort of had the questions that sort of, yeah, that I think is important. So I think we've covered it.
Thank you so much for coming here, Erik.
Thank you.
And thank you to everybody who's been listening in. These presentations will be available also on the same website as you are watching them on now. Thank you very much. Bye-bye.
Thank you. Bye-bye.